Masterminds have been around for a long time, right? But unless you had a bunch of extra income to throw at it, you couldn't be a part of it. Well, we wanted to solve that problem. And so we're bringing masterminds to you for free. Welcome to Mastermind for the Masses. Everyone, welcome to this week's episode of Mastermind for the Masses. I just want to kick things off and say, Shan, how did you do during Milton, man? I know that just came through and kind of wrecked this area. How'd you do? You all right?
I did all right. I lost a ton of pool screen from the wind, but other than that, I didn't get any damage. I didn't lose any power. I got real lucky. Everyone else that I know did. So definitely pretty fortunate. But how'd you do?
We were without power for a few days, but all in all, can't really complain too much. We didn't have any real property damage. Everybody's safe, which is the main thing. So no complaints really. But a little back to the basics of camping for a little bit in the house, but it was all good. So
yeah.
But obviously that storm got me thinking about risk and whether to leave or not and evacuate or kind of hunker down and hope for the best. And ultimately we decided to stay. But it got me thinking about risk in general, right? One of the things that we do in life is we take risks, and we do that in hopes of a reward. And what can happen sometimes is once we start to get more of those rewards, we have more to lose. So we kind of become risk adverse. So I was curious, knowing that you're a guy that doesn't shy away from risk when he thinks it makes sense, I was curious what your approach to that is and maybe how you determine, a good risk or a risk worth taking versus a risk that you want to avoid.
Yeah, I guess for me, and I think for most people, when it comes to measuring risk is measuring the outcome, right? Like what potential could you get out of it? But for more importantly to me, like if I'm going to do something risky, which you're right, like I have taken a few shots at like some heavier risky items, but for me, what always makes it a little bit comforting, or at least makes the decision easy to kind of decide on, is going to be, is the outcome reachable, even if it becomes more difficult, right? Like, is it something that, like, I'm taking a risk for an outcome that it's either binary, like 1 or 0, it's going to happen or it's going to not, or is it just going to be an outcome that could potentially happen? It could be harder than you expected, but still can, like, the potential is still there, the possibility is still there, but the path, or at least the pathway to getting to that outcome isn't what you expected. So that a lot goes through my mind whenever I'm thinking about evaluating risk. I don't like to take chances on something that just like could be binary, right? Like betting, I'm not a gambler. I actually lose all my money quickly, and I don't even have fun doing it. When it comes to gambling, I'm just not good at it. And I'm super grateful that it's a trait that I'm not, like, it doesn't inspire me. It doesn't get me excited. It doesn't do anything for me, which I'm happy about, because I'd probably lose all my money quick. But that's kind of often how I think, or what my thought process is when it comes to evaluating risk. Like, is the outcome achievable in any direction, even if it becomes harder or easier, depending on what you're doing?
Curious to think. So I want to dive into something you said in a previous podcast. You talked about stock investment, right? And that you had made this massive return. But then you kind of doubled down, right? If I think about it at the blackjack table. So saying you don't typically lean into that, but really wasn't that more, I guess it wasn't completely binary, because it wasn't all or not, right? You could lose some, but you still might be okay.
Yeah, so that situation's more like you found $20 off the street, and now you think you have you got a free shot at scratch offs, or you got, I don't know, something to blow money on, right?
Gotcha.
That's kind of the scenario that happened there. It wasn't necessarily money directly out of my pocket. It was more about, and I guess the risk management there was like, can I take something that I kind of won big on and make it into something I won huge on, versus like neutralizing myself out or equaling myself out and being happy I at least took the shot. Because again, like when you're thinking about risk, no matter what, I could break even at that situation. And I am not literally boasting at all about my decision there, because in reality, I took a bad risk, but because of the way it built up to the decision, I didn't take a loss.
Gotcha. So is it safe to say that you're a little more willing to take risk when you're playing with house money instead of your own?
I think everyone is, for
Yeah.
sure, right? Yeah, and that honestly, I feel like that's the only time people realize that potential outcomes are a lot, like positive outcomes are a lot more reachable than you think whenever the risk is minimized, right? Like if someone else is taking on the risk, you might realize that what you were shooting for is a little bit easier than you thought it would be, or it might take a little bit more work, but it's kind of one of those situations where like, man, it like I did it, like I did not think I'd ever get to this point, but I did, and it wasn't as bad as I thought. Like if it was house money that could get us there every time, I think everyone would take risks and they would realize that they're worthwhile. But
No.
I think about that a lot too.
Yeah, no, it's definitely easier when it feels like it's not really a negative impact. So can you leverage more of a positive experience, or at least make yourself net neutral? That helps mitigate the risk. But I want to pick your brain on something else, because as you're talking, kind of made me think. So I'm thinking of like someone's professional career. Okay, over the years they're going to get raises. It's going to happen naturally. Sometimes they may match inflation. Sometimes they might beat inflation, or sometimes they might, not quite reach inflation. So it's not exactly the same as finding $20 on the street. But on those years where you beat inflation, let's say inflation's at 2.5%, which it's trending at this year, and you get a 3.5% raise. Why is it, do you think, that people don't look at that 1% increase in purchasing power as house money and take bigger gambles with that? If they've been fine and they maintain their purchasing power because they've kept at the same rate of inflation, why then would someone not be interested in taking that extra 1% and I guess, for lack of a better term, trying to gamble a little bit with it?
Well, dog going at it. But honestly, well, just to poke a hole in your situation, it's generally more than 2.5%. So it might be globally 2.5%, but we feel it a lot more because of that 2.5% that it's hitting is affecting our daily. So it's a little bit less noticeable. But I know in your situation, or at least in you're an example, you're talking about why we don't recognize that 1% as a house money for risk. And I'd like to think some of us do, but there's also there's a safety factor too involved in that. It's kind of like protecting the egg.
Yeah.
A lot of people they might envision in their mind, man, if I had $10,000 right now, I'd invest it hard and I'd flip it into 20, and then that 10,000 hits their bank account, and then they're more like, I got to protect this at all costs because
Right.
I
Well,
really don't.
that goes back to what I was saying a bit ago, right? When you get more to lose, you become almost more risk adverse, but you probably got that 10K by taking a risk. You see the conundrum.
Yeah, exactly. So one of the hardest things I think in life is to not acclimate to that raise or to that new standard of living whenever you might run into a little bit more money, because it changes your mentality a lot and it makes it harder to go at life with a little bit of an investment mindset. And I even struggle with that too sometimes. But you're exactly right. Most of the time when people they achieve those financial goals, or even if it's not financial, some kind of uplifting goal, they become more protective about it, which isn't a bad thing, I think.
No, I think you have to balance it, right? I mean,
Yeah.
it does feel differently losing $100 versus losing $10,000, regardless of where your income ratio is, right? It does.
Yeah.
It does have a different feeling.
And risk mitigation is everything too, right? Like if you're, I don't know, if you're me and you and we're starting like a software company, or we're starting a service or something, the potential risk is a lot lower and the outcome is a lot higher, right? But if we were Elon Musk or Bill Gates and we were wanting to start our own new LLC and new software or service company, the risks are much higher, right? Because you have more to lose,
Mm-hmm.
and at the same time, you have more exposure to those situations where you have more to lose as well. So it's a safe mitigation, like risk mitigation adjustment that you have to make whenever you hit a certain goal or a certain like financial outcome, but it's a tricky maneuver for sure.
Yeah. One of the things that I think can be helpful to kind of as one of those high performance hacks we're always talking about, in order to kind of free up yourself to be willing to part with money a little bit more. Because usually, a lot of times, the risk comes down to a financial investment. I mean, or some kind of asset that you have. You're not. There's no benefit to you crossing the street without looking. Like nobody's taking that risk, right? But you're like, okay, well, I want to invest in the stock market or something like that. Now
Mm-hmm.
there's a little more risk around that, and it's tied to the fear of losing that financial standing. So one of the things I have found to be helpful is to really lead a portion of my money in like charitable type of things, right? Because if I'm giving away some of what I've received, it makes me less clingy. I have. Sorry, I was about to sneeze there. it makes me a lot more willing to part with the money when I'm freely already giving away some of that money, right? And I don't know exactly where the thresholds are. That's something I'm personally trying to work on. Is looking at, okay, what what can I give away? What do I want to pay myself first? What do I owe Uncle Sam, of course, tax wise? And then, can I live off of the rest, whatever those percentages equal out? And I don't think that's new knowledge, right? I mean, we talk about a lot of charitable donations, people can tend to write off in taxes, which reduces that overall tax burden. And then, they always say to invest about 15% of your income, back into yourself. So that's kind of paying yourself. So I think there's, like I said, it's not a new concept what I'm talking about, but I think putting that charitable aspect in there makes you less tied to your money, and you might be a little more willing to risk it. Does that make sense, or does that align with kind of how you think about it, or do you have a different strategy for when Because obviously you have a certain amount of money come in, you look at it and you say, okay, I'm going to put X into investing, right? How do you determine what X is, if you will? Or how do you reconcile with that to be okay with it?
No, I think that's a really good tactic for sure, and it opens up your your mindset to being able to kind of diversify and spend your money on something that's not so personal, right? Like, and at least when it's charitable, there's a really good moral return on it too, as well. Because no matter where you are in life or what situation you're in, like you can give back. You have no idea what that can really do towards your
Mm-hmm.
mindset and what
You
kind of
could do.
positive outcome you can get.
Sorry, I was just
So,
going to say it doesn't have to be financial, right? I mean, because I know some people and some of our listeners may not be in that situation, but you could give time, you can give your talent, you can,
yep.
there's things that you can do, and it still puts you in that same mindset.
Yeah, and that's kind of how I would answer your question too, right? Like, I think so. If you think about oftentimes where people make bad investments or bad business decisions, or just structure things in the way where they're not successful, a lot of the times, majority of the times, the situation is when they run into a sum of money, they might get a loan, or they kind of produce what's needed to get started overnight, right? Like a lot of situations I see is people go and get business loans, or they save up, 10, 20 grand, and they buy absolutely everything they need to start a business, or they throw it into one stock without learning about the stock markets, without building a portfolio or anything. And either they get extremely lucky or they lose it pretty quickly. And the same as goes to business. And that's kind of one piece of advice that I often give anyone who talks to me about starting a business or starting a brand or building something, is I always challenge someone to take the money that you want to spend on investing into your company and build it, right? So that doesn't mean like, take 10% of your savings, take it out and just, go kind of blow it on the supplies you need to start a business and register an LLC. I mean, I can back it to like a quick story of how I got started. The way I got started with registering businesses, building brands, and kind of making those decisions without going negative and going out of business is I started retail arbitrage, right? Which is basically finding things cheap online, either between sales, finding them on eBay, finding them used, going to yard sales, whatever, and reselling them for a profit, right? There's multiple ways to do that, but what it allows you to do is it allows you to invest really slowly and build at your own pace and kind of learn financially, like what needs to be done, what needs to be saved, and how much to invest slowly. And it allows you to build yourself up. So for my specific situation, I was retail arbitraging Walmart products and selling them on Amazon. Not the most like profitable thing to do, but the best part about it was I was able to take that risk management or mitigation that we're talking about here and minimize it, right? Because I was buying things from Walmart in bulk and selling them on Amazon, to where if for some reason they didn't work out, Amazon lowered the prices, or I couldn't no longer sell the product, I have a return window through Walmart. And if things don't work out, I can always take my investment back and learn my lesson without losing financially. It also allows me to do one at a time, right? Mm-hmm. So the very first thing I ever flipped on Walmart and Amazon were these $2 lightsabers. These little $2 like lightsabers that Walmart was running a huge sale on, and they're like $10 on Amazon. So after fees and everything, I wasn't a ton of profit, but it allowed me to learn quickly like how to make a few bucks, and then how do I reinvest those few bucks? And exactly what I did. I took that money, I bought more product through Walmart. I learned real quick what wins and what loses, and I slowly built that into. I actually built that into Royal Beardsman. I started Royal Beardsman with no money out of pocket. It was completely financed with me and one other partner through retail arbitrage. So we actually didn't have to come out of pocket at all for that. Wow. And then I used Royal Beardsman. I collect a salary from that. I used that to build All at Bay, and I used it to build a couple more LLCs. And that kind of, to answer your question in a long, long story, that's kind of how I figure out what should be invested when it comes to risk management, is how much can I generate with the successes that I've had, and with those successes that I have, what can I replicate to make the same process work?
Yeah, man, you've really maximized that house money. And for our longtime listeners, I'd love you to go back to episode 1 when Shan tried to say he was not a serial entrepreneur, and then listen to the story he just told and tell me that you disagree with that. Oh.
Yeah, again, the reason I say that is I don't think you need to be a serial entrepreneur to start a business and make this stuff work. I think you just need to have interest in monetizing your free time.
Yeah.
And you can decide. And that doesn't have to be money, just like you said. Like mm-hmm. if it can be like long-term career growth by like learning new skills. Yeah, exactly. Or just improving your overall, I don't know, like marketing skill set, or even if it's career oriented, like that's still to me monetizing your free time.
100%. That includes things like working on your brand, and because especially when you're looking at your career, not everyone's going to know who you are, right? And you want to make sure you portray what you stand for, and there is some strategy around that rather than just whatever you happen to be doing at the moment, right? So
yeah, and I see yourself doing it often too. So you take kind of what you've built your expertise on, and you're able to expand that into coaching, into speaking, and just any kind of general mindset and life advice kind of tactic. Even this podcast, right? Like this podcast, it was an investment of the skills that you've learned over the ventures that you've had, and you're growing it into something else, which is probably going to spiral into 3 more domino effects, and you'll do 3 other things that you've learned from the skill set of editing and putting together podcasts as well. So it's kind of the same concept.
It's entirely possible, and I think exactly what you just said. illustrates what you said earlier about, it doesn't happen overnight. Most of the time it happens over time. Yeah, there are some people that get lucky and they buy that, winning lotto ticket. But you know what? A lot of times those folks, because they haven't learned those skills over time, a lot of times they wind up blowing that and then they're back into where they
Yep.
were, and lost that great opportunity. I know, going back to your stock investment, someone that doesn't do any research and just throws it in, even if they get lucky, now they think they're good. They're going to go take another lucky guess and,
Yep.
feel it. Um,
Yeah, unfortunately, they'd have to be really disciplined to not blow it. And if they were really disciplined, they probably would have never started.
right.
So, yeah,
Yeah. Now, risk mitigation is definitely one of those things that's interesting because you're not going to yield rapid results unless you're willing to take a risk. But risk inherently can also cause you to lose what you've built. So it is really, what are you willing to gamble? And I like your strategy of figuring out how to use house money. You know, and that takes me back to my analogy earlier, right? On the, if you do happen to get a compensation increase, rather than necessarily adjusting it all for your life cycle, maybe there's a world where you can take a portion of it, right, and still increase your life cycle or lifestyle. But then you take another portion of it and you invest it as house money into whatever interests you. For like Shan, I could see you firing up another business. I'm recently getting into stocks. So at some point, I want to pick your brain about that probably because I think you have a lot more experience than I do around that realm. But to reinforce your point, I didn't just go in and look at the call sign and say, hey, I like those three letters, right? I did some research, I dug into it, and I spent a little bit of time putting together a portfolio. And right now, I'm pretty happy with how it's doing. I mean, I didn't throw a lot in, so it's not like I'm getting ready to retire or anything. But when I look at it ratio wise, the risk versus reward is there for me. But I am taking steps to mitigate the risk. Right? I've got some defensive stocks. I've got a lot of dividend stocks. I've got long term growth in there, as well as some stable bond like ETF type things. Just a nice little myriad of things to try and protect myself from a loss. Now, that lower risk means that my return isn't as rapid, but it also means it's not as volatile. So essentially, I'm trying to play with house money. I'd love to get to a point where I can take my initial investment out and literally just work off of what I've created in that spot.
yeah, yeah. No, that's exactly it. I think all risk is dynamic. Like if you were to put risk on a hot to cold meter, I would like what would control that from spiking or lowering is really going to be time, and with that time is going to be towards building skill set and pacing yourself, right? Because look at like yourself, and I think it's pretty doable to have the success you're having in stock investing. What's difficult is when maybe you started with $200 and you double it, and what eventually goes in your mind is like that could have been $2,000, that could have been 20
Right.
grand, and like how like what am I doing wasting my time? Let me dump everything I got and try it again, and then it just
Takes
causes.
a dive.
Yeah, exactly. So like if you can take that time to lower that mitigation of risk, because like you say you did double that money, you got $400 out of 200. You keep going at the same pace or up it a little bit, your risk is going to stay pretty low.
Mm-hmm. Yeah.
Whereas you might not get that 40 grand that you were hoping on by putting all 20 in, but right away. But at least like by the time you hit to that 20, you'll be a lot more skillful, and the risk meter will be way low by the time you're ready to try to flip that into 40.
Yeah. And I'll be honest, I'll share with our listeners what I'm shooting for, right? I'm looking at a 10% return. That's my minimum threshold, which I think
Yeah.
is aggressive, but not as aggressive as some folks I've heard. I've heard some people going for like 16, 20, or, in your example there was 100% return. I'm not quite comfortable enough with that
Yeah.
level of risk at the moment. So, I put myself in kind of, I would say, a moderately aggressive stance.
Yeah.
And I've only put in there what I'm willing to lose because,
Yeah.
as we all know, I mean, it is a volatile thing. It could happen tomorrow where they all tank and I'm out.
Yeah, yep. And hey, there's strategies to fulfill both, right? When people are looking for that 100% gain, they'll take the strategy you get into some dividends, get into some safe and non-volatile stocks, build 50% of your portfolio on that, and maybe dedicate 10% of it to some swinging,
Yeah.
some short-term trade.
Well, what I'm hearing from this conversation is any of the revenue I make on the safe bet, right? I need to take that because it's house money at this point and throw that at some of those big swings. Because if I lose it, that stinks. But if I get it, hey,
that's the strategy for most. That's the strategy for the big players for sure. Though, and what it allows them to do is build their long-term portfolio to be stronger and stronger to where like the minimum might be 14% on their year-on-year return instead of 10%, just because they've gotten that good at it, not because they're taking a little bit more risk.
Just know how to do it, and this is new for me, so it is going to be a learning adventure. I mean, I've dabbled in the past, but I took more of that shot in the dark approach that we were talking about, and I've failed every time. So this time I try to go into it with a little more research, mitigate that risk, and hopefully that will yield a better reward. It's kind of the idea.
Nice.
Yeah. So I mean, I just really wanted to see what you thought about risk and how you identify. Like, are there any signs that our listeners could look out for that inherently are like a red flag around risk? Like obviously we talked about ways to maybe mitigate and manage the risk that exists, but there are some times where you get an opportunity that's almost too good to be true, and you really want to take it because the reward is massive. But when you're looking at that risk, how do you know if it's worth it? Because there are some too good to be true that I think do wind up being true, but it's more the exception than the norm.
Yeah, honestly, I don't believe in anything with a get rich quick kind of label. Mm-hmm. And I know that like people always say that, but even if it comes into something that doesn't require you to learn the skill set or do better than the top 10%, I don't really believe in, just because sure, you might catch something in a good time when it's early, and you might be able to make a ton of money without being that top 10% in performance, but it's going to be short lasted. And generally when it's short lasted, that comes at a cost for sure. But I think that's the biggest red flag, right? Don't ever approach anything thinking that you don't need to get really good at it, or at least get obsessed with it. And you don't have to be really good at anything. You just need to be able to be obsessed. And I know that sounds crazy, but it's commonly what drives people to become that top 10%. It's not even because they're that great at it, right? They're just consistent.
And put more time into it.
Yeah, and you're talking about low risk mitigation. One that I'm seeing right now that's really common, and I am dabbling in it myself, and I'm seeing the really, really great reward versus risk is affiliate sales, specifically in TikTok Shop. TikTok has a program where you can promote products, and you might have them in your everyday home. You can apply for their TikTok Shop program, promote those products, and you see commission rates from anywhere between 6 to 20%. They're crazy high because TikTok is trying to take on companies like Amazon, where they can kind of have that market, Amazon, eBay, the other markets. So they're really being generous right now with all the incentives and the commissions and stuff. So that's a really low risk item, right? Because if you do it correctly, one way to do it, right? Let's give an example of the high risk way to do it. And it's a very low risk situation already, but a high risk example would be, I want to make as many videos as I can to potentially get the best commission I can. So I'm going to buy up all of these products on TikTok Shop and get them sent to my house, and I'm going to make a ton of videos on them a day. If you're super motivated, maybe that might work out for you, because I've seen people go viral just one time and make $15,000 to $20,000 off of one video. It's insane. But you just if it doesn't work out for you, you might have just put yourself in the hole, $500 to $1,000, right? Whereas the smarter thing to do, which is kind of what I did, is I went around the house. I found every single thing I have that TikTok Shop includes in their program, and I made videos on that, to where it was zero money in, kind of zero risk. Just the only risk was time.
Yeah.
And that time, it was going to require me to work a lot harder to earn that money than it would be to buy 20 products and just hope that I found a pretty good one, right?
Well, yeah, I think that's another thing that comes up. Scale your success, right? And you alluded to this earlier. You could take all your money and go buy every single thing you think you need, and a lot of people do that. And unfortunately, that is what cripples a lot of those startups. You know, rather than just getting the exact basics that you need. I mean, you started. I don't know exactly how you started with your arbitrage there, but I'm curious. I know for a fact some people do this. They put things up that they don't even own yet. Right? They say, okay, I'm selling this thing. And then as they receive orders, then they purchase it to fulfill the order. So they're getting started for almost zero cost, right? Maybe a small investment of time, possibly a small investment if you do register your LLC or anything like that. But there's a lot of people that they kind of get in the game with very low cost. That way, if it fails miserably, you're out nothing and you move on to the next project. As opposed to trying to cover all your bases at the beginning. I think you actually put yourself in a riskier spot by trying to, I guess, mitigate the risk in that way, right? So I guess another tip for our listeners here would be is focus on the risk in front of you and focus on mitigating that risk rather than, the what ifs that could come.
Yeah. No, I like that you brought that up too, because I actually know a couple guys who I'm in quite a big community of other clothing brand owners, and so I get to learn about their journeys and their ventures and how they got started too. I actually know a couple guys who sold designs and mock-ups of clothing that they didn't actually have produced yet.
It's not wild.
They had their website up. They're testing. They're testing the conversion rates and seeing what works and what doesn't work. And yeah, of course, unfortunately, you had to refund a couple customers, and they were the kind of losing side on this scenario or this test experiment. But it allowed them to strategically see what will work before they even get started with almost zero money down. I literally know guys who have made sales on their brands before they even started, and that is to me, that is like hacking the game right there, and it's a really good mindset to follow when it comes to any kind of risk mitigation.
Yeah. Testing the waters before they dove in. That's awesome.
Yep.
Well, Shan, I know both of us are kind of on a tight timeline today, so I think this is a good spot for us to throw in final thoughts so that we can keep moving throughout our day, but appreciate you finding time to really make sure we could get this done, as well as myself, because we want to always be here for our listeners. But I'll flip it over to you. Final thoughts around risk mitigation and management.
No, yeah, I'm no perfect saint when it comes to risk mitigation, for sure. I've definitely taken bigger risks than I should have in life, but I want to reiterate on kind of how I started the business venture and why I really haven't, luckily and faithfully, I haven't struck out yet. Is mostly because I follow that concept of house money that we talked about, right? Like, you start small, you build a portfolio, whether that would be, $100, $200, whatever. Build it. Don't just grab it, because it teaches you a lot along the ways, and you really learn the ins and outs of the entrepreneurial mindset just by following through. So if you're thinking about something that's a real big risk, if you're thinking about starting a business or investing in stocks or whatever, really think about how you can start with house money, right? Think about how maybe you can work an extra weekend, pick up a shift, or even just retail arbitrage, go to a few yard sales and flip some items online. It's going to be the longer way to achieve your goal, and it's not going to be as exciting as, taking a portion of your savings and just going all at it. But trust me, it is so much harder to lose when you're building the skill set needed to lower risk mitigation. I mean, it's almost impossible, right? If you're doing exactly what needs to be done in a larger scale on a small form, your chances of losing are a lot lower than they would be with just starting blindly.
For me, I would say consistency is key. We started this podcast today, 35 minutes ago right now. And at that point in time, I was down 0.5% on my investment portfolio. And I just looked at it to see where we're at. And I don't recommend you keep such a close eye on it. But this was for just the purposes of this pod. I'm actually up 0.5% now. So in 30 minutes, there's been a shift of 1 full percent of my investment into a favorable. Now, by the end of the day, it could drop again. And that's something that will happen. And I don't suggest that people keep that close of an eye on it. I literally did it just for the pod here because you'll lose your mind watching it like that. But I wanted to show you that consistency in time can have impacts to that risk and that risk mitigation. And that's a perfect real world example of how that can happen. And since I am speaking to consistency and the return on investment and the risk mitigation over time, I'm going to be consistent with the way I close and ask you to share this with all of your friends, post, reshare, whatever makes you happy. That'll make us happy too. Comment, and we will connect with you next time here on Mastermind for the Masses. Thanks, everyone.